Welcome to this video on profitable ETF gap trading strategies. This is Mark from tradingform.com and welcome to this video. Traders are endlessly fascinated by gaps, the distance between the closing price and the opening price of the next bar. In this video, I want to have a look at some quantitative data to understand whether gaps can actually give you a market edge, and if so, how to trade them. I've looked at 3 of the most popular ETFs and I've got some fascinating results that I'm going to share with you in this video. I've looked at the SPY ETF, I've looked at the QQQ and I've looked at XLF. Whether you're trading intraday or you've got a holding period for 2, 3 or 4 weeks, there is a lot of information in this video for you. On the screen I have an example of what I am testing. We have a gap higher that closes during the day and then I'm going to enter the trade at the closing point of that day. On the screen you can see the backtest model that I'm using for this test. This is a trade-informed backtest model. It is built in Excel using Excel formulas, and you can use it to test all sorts of different types of trading strategies. If you want more information, there is a link on the screen at the moment and below this video. Now the first variable we're going to test is a gap up and a gap down. We're only testing long trades here, so a gap up, surely that's a good thing. There's been some positive news or something to get traders excited, and so we've opened up at a higher price compared to the close the previous day. But a gap lower, surely that's an opportunity. There's some temporary negativity in the market. We've got an opportunity to get into the trade at a better price. Let's look at the difference between them. So I'm identifying a small gap up. We can see here the variables between 0% and 1%. So we've got a small gap up, and I'm looking here at, using this drop down menu, I'm looking here at XLF. Expectancy per bar, expectancy per day. If you're testing on the daily time frame, we can see it's highlighted green to show it is higher than the average daily close. So 0.18%, 0.04%. We have 350 odd trades here, so we've got a decent sample size. All the trades higher are done in the same way. We're looking for trades that have closed during the same day, so there's no outstanding gap that's going to hold us back. We've already closed, we've got to the end of the day, and then we have set a limit order to get us in at the next bar. Okay, we're looking at XLF here, and we've seen expectancy per bar. Let's have a look at the Qs. You see not quite as high as XLF, but still significantly higher than the average daily close. And you can see over this time period, the Qs has mostly gone up. We've had 56% up days. And that is enough to give us a compound annual growth rate of higher than 17%. So there is a lot of up days, good up days to consider, and that is only an average of 0.07. So 0.12 is pretty decent. Let's have a look at the SPY. Again, we've got a green here. We've got expectancy per bar roughly double the average daily close. Now, let's have a look at a gap down. Switching back to XLF, very easy to do using this model. And again, I'm going to do a small gap down between minus 1%, let's do this again, and 0%. Okay, so we've got a different scenario being tested here. XLF, we can see a downwardly sloping line. Again, we have a lot of trades here, over 350 this time, but it has not been a decent proposition to trade these. If we have a look at this upwardly sloping but choppy XLF market, we can see that a gap down has generally not been a good sign. Now, if we look at the Qs, this very smooth and powerful uptrend, we can see that a gap down has generally been a pretty decent proposition. We've again got a decent expectancy per bar. We're looking at the percentages here. We've got 61% winning trade as against 55%. Now, there is a lot that day traders and short-term swing traders can make of this information. You don't have to trade exactly the same scenario to take this information and put it into your own trading strategies. Let's have a look at the SPY. We can see the SPY is lower. We've not got a green here. We're lower than the average daily close, which is suggesting that we haven't got much of an advantage here. In fact, we've got slightly worse than average for the SPY. Again, another interesting finding. Now, the next thing I'm going to test is whether to enter using a limit order or a stop order. Now, the previous test I did using a limit order. Now, this is how I've got this particular model set up. But as you'll see, there are some differences between how the different markets respond. So a limit order, if we're talking long trades, is a retracement to the downside, and we can enter at a better price, theoretically. A stop order, we expect the market to have reached a minimum price before we enter the trade. So if we look here, we've got XLF set up. Again, I'm looking at a small gap up between 0 and 1%. We look at the XLF. We've got decent expectancy per bar, but slightly worse than when we used a limit order. Quite a bit of a difference, really. Again, we've got quite a few trades here, 340 trades. Let's look at the Qs. And we can see here expectancy per bar that is very solid, and this is not surprising if we look at this type of market. We all know the Qs following the Nasdaq 100 is a strongly trending market, and often the advantage can be to make sure we get in and we don't miss any trades. Whereas the XLF, an upwardly trending market historically, is a bit more choppy and not quite as dynamic. So we've got the SPY, which is a slightly watered down version of the Qs, we could possibly say, considering the tech influence in it these days at least. We can see we're getting a pretty average expectancy per bar, nothing exciting there, about the same as average. Right, let's go back to our XLF and look at a gap down. We can see here it's performing slightly better, but still nothing exciting. In fact, worse than average. Worse than the average may just be a random result. Look at the Qs again. We're getting a decent expectancy per bar. Again, the limit order, getting a stop order is not a bad way to trade the Qs. If you're trading this as a day trader or a swing trader, you could use this information to fine-tune your entries, look for the percentages. Use this or something like this as a tool to refine the way you trade. And going on to the SPY, again, we're seeing nothing particularly interesting at all on the SPY. Expectancy per bar, pretty similar to the average daily close. The third variable that I'm looking at here is how long to keep the trade open for. Now, this information is extremely important for swing traders to know how long the edge is worth keeping hold of. Whether it's going to be a few days or even a few weeks, it makes a big difference to how profitable each individual trade is, how much profit you can wring out of each trade. So if we have a look at the XLF, we've seen this before on the limit order. If we increase the number of days holding period, we can see the edge disappears almost entirely and becomes negative. So that is a result that we need to be aware of, possibly even be looking at short, considering how quickly the edge disintegrates. If we have a look at the Qs, we're going to get a slightly different picture. If we start opening up for 2, 3 days, you can see we're holding pretty decently, and it takes a while before our expectancy is coming down again. You can see after a few days we're more or less back to average, but our average trade expectancy is still higher, and this is what should interest swing traders, because this means that our costs per trade, a cost benefit in terms of how much we're paying for the spread, is going to be better. Now let's go back to 1 and have a look at the SPY. Again, we're testing a gap up here. Oops, if we go this to 2, we can see again the advantage is not holding here. But if we go higher, we're getting some fairly choppy results here. We're seeing something that is more or less going back to average, mean reverting. So we've probably got maybe 1 or 2 days advantage when we're using the SPY. Now let's see how that is affected when we're looking at a gap down. So XLF, if we increase it, we're really getting no advantage at all. So it's not even worth looking at that for the limit entry. Qs, once again, we're getting some of the best results here with the Qs. Average trade expectancy 0.52% for an average trading time of just under 5 days. So if we push it up to 10 days, we see we've got a higher trade expectancy, but the advantage of holding it for those extra days is fairly minimal. And if I push it up to 15, 3 weeks, 4 weeks, we can see we're actually holding more or less. We've got some high trade average expectancy, but the expectancy for each extra day may not be worth the extra time and the risk of holding it. Okay, so there's one final variable that I'm also going to introduce, and this is the minimum consecutive preceding down days. So we want to identify markets that are at least in some sort of downtrend before we enter into the trade. So if we go back to the gap up and we stick it onto the XLF and we see what a difference we can make. Got 180, 190 trades here. Got a pretty good expectancy for just a single pass. That is worth bearing in mind, that having at least one preceding minimum day is doubling our average returns. If we look, set that back to 0, gone to the Qs. Again, we see something pretty similar. So by making sure that the market's gone down slightly, we are reducing the overall number of trades, but for each individual trade, statistically, we're getting a better result. Let's see if we can, if we go on to 2 and 3, all of a sudden this breaks down. So again, we've got some useful data that a small retracement may well increase our odds of finding a nice strong trend. Longer retracement than that may not be so beneficial. If we look at SPY, set this back to 0. Again, we're seeing a similar thing. Single day is giving us very good results. 2 days, much poorer results. So again, there may be something in that, particularly for day traders looking at maybe profiting on the long side and then being clever, turning around and profiting on the short side. And if I do the very last one I'm going to do today in this video, let's go and look at the preceding days for a downtrend. XLF does not work as well for a gap down, but there is a slight benefit if we wait until we've had some preceding down days. In fact, we can see here that we're getting some green on here. So a couple of down days is pretty good. Oh, this was the SPY. Okay, so for SPY, yeah, we can see we're getting an improvement, which is pretty similar to what we were getting from a gap up. Now let's actually go to XLF. Again, no benefit for a gap down for the XLF. So we've got that information stored. Let's go back to the Qs, which has been consistently the best performer because consistently the market has gone higher. So we know that. We've got that information already. And we'll see here another potential improvement. So on this basis, both SPY and Qs, don't be afraid of a small retracement and a gap down, a small preceding trend and a gap down, because there may well be opportunities. Small gap down. There are all sorts of variables you can play around with here. This is a tool that will be practical and useful for your trading. If you're trading these markets, If you want to trade some different markets, you can plug them in and test them using this model. Now, I hope you found this video useful. This was a guide to different ways of trading gaps, gaps ups, gaps down, different ETFs. If you like this video, please hit the like button. If you want more content like this, please hit the subscribe button. And for more information about trading the financial markets, and in particular about backtesting your trading strategies, becoming a better trader, please go to tradeinformed.com.